Welcome to the Chrisman Commentary, daily mortgage news podcast. I'm your host, Robbie Chrisman. Topics on today's episode include government shutdown central. My interview with Spring EQ's Reno Heine on when and why loan originators should consider HELOC and HELOAN products for clients, key factors in choosing between them, and the future outlook for second mortgages. And furloughs and labor reporting are now squarely in the spotlight, especially when it comes to interest rate movement. Looking for smarter home equity solutions? Established in 2016, Spring EQ is now one of the nation's leading non-bank home equity lenders, giving partners more ways to serve customers. Choose from a variety of products, including fixed line, their unique take on a fixed-rate HELOC, along with traditional HELOANs and HELOCs. Known for speed, service, and innovation, Spring EQ makes tapping into home equity easier. Learn more at wholesale.springeq.com. Come on, you don't believe politics and mortgages are separate? Look at politicized government housing agencies. Whoever's running HUD, whether it's Bill Pulte or Scott Turner, had a nice note on the website yesterday saying, quote, "The radical left in Congress shut down the government and HUD will use available resources to help Americans in need." I actually had to click through a pop-up that said that to get to the homepage that said that. Wasn't it just a few weeks ago that all we had in the news were tariffs and Fed Governor Lisa Cook? By the way, all the living Fed chairs have come out in favor of Federal Reserve independence. I guess I will too. And against the firing. And mortgage occupancy fraud involving her and President Trump's cabinet members. Well, apparently the latest in the case is that if the Trump administration has a smoking gun against Lisa Cook, we haven't seen it yet. Starting today, the shutdown has necessitated a furlough of certain federal employees and significant curtailment of certain operations requiring agency staff intervention or action at the Department of Housing and Urban Development, Veteran Affairs, and the Department of Agriculture. National Flood Insurance Program authorities have expired today. The NBA continues to advocate for an extension of NFIP's authority to avoid disruptions to the housing market, including other trade groups in a letter to congressional leadership. Without reauthorization, FEMA cannot issue new flood insurance policies or renew existing ones. New policies can't be issued during a lapse in authorization, and renewals can't be processed if they fall during the lapse. Existing policies remain in force, but no modifications can be made. And yes, yesterday's month and quarter end brought the customary torrent of economic data, but the impact on markets was muted as traders were more concerned with the U.S. government beginning its first shutdown in nearly 7 years. Beyond potentially delaying Friday's jobs report, some are even saying that the shutdown could stretch all the way to the Federal Reserve's next meeting on October 29th, upending the path of interest rates along the way. And the Trump administration's potential mass firings of federal workers would send jobless claims rising even higher in a troubled job market. The takeaway is that even though mortgage rates enter the fourth quarter lower than where they began it, there's very little clear perspective going forward. For today's interview, I wanted to welcome back to the show Spring EQ's Reno Heine to talk about when and why loan originators should consider HELOC and HELOAN products for clients, key factors in choosing between them, and the future outlook for second mortgages. He has nearly 30 years of success building and scaling mortgage-focused businesses, driving growth and profitability, with over 20 years of direct P&L responsibility. He was instrumental in developing 4 of the largest wholesale mortgage companies of their time, including Rocket TPO, Maverick Funding, HomePoint, Equifirst, and Decision One.
I think now is a pretty fantastic time to be having a conversation about HELOCs and HELOAN products because we've seen incredible demand out there. There's incredible tappable potential for the everyday borrower. Some of the stigma around these products has faded away as people have become a little more educated, which is great as well. Spring EQ is obviously in a great position to capitalize on a lot of these things. And we've also seen through this market cycle, and hopefully we're on kind of the rebound and the upslope here, but in the doldrums, originators were trying to find every possible product they could for borrowers. I don't want to turn you away and tell you to go to a competitor because I don't offer a product. And so we've seen a lot of originators add to their product offerings, and HELOCs and HELOAN products are certainly up there with kind of top of the list for what they should be paying attention to. Is there kind of like a when they should recommend these products to their clients, or even we can back up and say like a why?
Yeah, absolutely. The market has shifted tremendously. We think that Spring EQ came in at a perfect time In the past, it was very common for loan originators just to send second mortgages or the second mortgage clients over to the local bank or credit unions. And we think there was a lot of lost opportunity there. Not only opportunity to keep your clients under your umbrella for their future purchases or refinances, but also immediate income in what has been a little bit tougher time over the last couple of years.
So let's shift from kind of the originator to the borrower here. And if you're a borrower, and you're thinking about one of these products, hey, my credit card interest rate's in the high 20s, maybe even 30%. My auto loan is in the teens. My personal loan's in the teens, whatever it might be. What should people take into consideration, I guess, in considering these products, but also deciding between a HELOAN and a HELOC?
Yeah, there's a couple big factors there that I think clients need to understand when you're looking at the differences in the products. So the things that I think the originators need to ask these clients to fully understand is, what's your ultimate goal? Do you have one big expense I'm putting in a pool or whatever it may be currently that you're trying to cover? Or is this something that in the future you may have additional expenses? Because the difference in a HELOAN product and a HELOC, the biggest difference is future ability to draw against that credit line, right? So if this is truly a one-time expense and the customer does not feel in the future at all that they're going to have additional needs for it, then a HELOAN may be the better product, because HELOANs traditionally, the rates are a little bit lower than HELOCs. But you don't have future draw opportunity. It's truly a second mortgage to cover your immediate needs. If that's not the need and a customer's looking at it because they need future draw capabilities, then a HELOC's a better option. The other thing that I believe customers should really consider here is, where is their monthly financial position? Because when you look at a HELOAN product, even though the rate's lower, that's a fully amortized loan. So the payments are traditionally a little bit higher than HELOCs, because HELOCs have an interest-only component to the loan, which keeps the payment down. But over the life of the loan, they may pay a lot more because they're not knocking down the principal of that loan. And the one thing I would add about that, though, is for people that truly understand the HELOC, these are loans that recast every month. So even though they're not paying principal when they're making only that interest-only payment, if they pay off in bulk sums when they get their bonuses or come along extra cash, it recasts, and that will give them the ability to continue to lower that payment.
Well, in addition to recasting, what are some common misconceptions that still persist, certainly amongst borrowers, but maybe even amongst originators when it comes to these products that could be good to clarify here on this podcast?
The biggest misconception, when you talk about HELOCs and HELOAN products, is that they are a bank product and people only need to go to their banks. We were one of the founding companies that were delivering a full suite of equity products to the broker community. But since then, a ton of companies have joined. We have a lot of competition out there. And what that's caused is for the rates to be driven down to where our rates for the brokers today compete with the credit unions and the banks. And that never existed until fairly recently. I would call it in the last year, where the competition has driven rates to the point that brokers can offer products pretty close to bank and credit union rates.
Yes, we've certainly seen competition rise as demand has increased. I know Spring EQ is well positioned there. I do want to talk Spring EQ in 1 second, but I kind of want you to pull out of your crystal ball first. We've mentioned this upswing here, and it's been kind of a boon for the HELOC or HELOAN side of things. How do you see the next few years playing out? And I would add to that, there has been all this talk of rates are coming down, and that's been around since the Fed first cut over a year ago. Yeah, we haven't seen rates markedly come down. They've dipped a little bit here recently, but not enough to cause a refi boom in a lot of senses. And so as we move forward here, what do you see? What do you portend for the space?
I wish I could predict rates. I'd be in a great financial position if I could, but nobody can. I believe the consensus out there is rates may come down, but realistically, how low? And when you're talking about tens of millions of people that back in the heyday of 2020 through 2022 refinanced or purchased homes in the 2 or 3% range, I do not believe we are going to see those kind of rates again. So when you look at it, there's always going to be a vast opportunity over the next couple of years for equity products. Now, does it come down a little bit if rates drop into the low fives? Of course it does, because then it might make more sense for people to refinance a first. I think it's important for brokers and loan originators to understand we're all trying to do best for our clients. And I've seen brokers every time trying to do the best for their clients. And I think it's going to get really difficult and hard. And we're going to have to be experts at our jobs to decide what is best for a customer, because there's always the option to refinance their first. But if they're sitting at a 3.5 and you can give them the same money that they need to pay off their debts and do the debt consolidations at, call it a 6.5%, 7% second, you've got to do the blended rate. And though there might be immediate, a little bit loss of revenue for the broker, you got to understand building that client, the relationship with that client, that pays off 5, 6, 7 times over the life of your relationship. So I believe that money will come back to the brokers, in fivefold if they're always doing the right thing by their clients. And that means do the math on it. Do the math. If you refinance their first and pay off their debts, what is their blended rate and their blended payments? And then do it on putting them in an equity loan. Because when you show that to your client and you show them, I had your best interest in mind, that client's coming back to you when they buy their investment home. They're coming back to you when they move, because you did the right thing by the client.
That's a very good point. And I know in addition to brokers, originators trying to do the best for their clients, Spring EQ is also doing the best for your clients. Let's talk competitive differentiators here. Why should those on the origination side look to business with Spring EQ over other wholesale lenders in the space?
The number one thing, and we meet on this multiple times each week to make sure that we are keeping our margins extremely low to offer the brokers and the clients the best rates out there, the best rates that we can offer. And we are extremely competitive in that. With that perfect ideal customer, low LTV, high credit score, we're lower than a cash out first mortgage. That's almost ridiculous when you think about it, that we're offering you a second mortgage, which ultimately is always a riskier loan, at lower rates than you can get a cash out first. We lead with rate because we believe in taking care of the clients and giving the brokers the best opportunity to sell against the banks and the credit unions for their livelihood. But even more than that, I really think we have one of the largest product suites of any equity lender. This is what we do. This company was founded and originated to do second mortgages. We've had a lot of competition come in because their first mortgage business is a little bit slow and they're trying to do the right thing and keep all their team members employed, but it's a secondary product to them. This is a primary product to us. So we're pretty good at what we do. We have continued to focus on keeping our turn times down, and we continue to get faster and faster in closing loans. And I think we're in a really good position there. As I mentioned earlier, very aggressive rates to make sure that the clients and the brokers are taken care of from that aspect. And then the full suite of products. I mean, we have a exclusive product in our fixed line. So we offer the HELOC suites, we offer the HELOans, but then we have a fixed line, which we found a gap in the middle of those two products, because you have certain customers that are risk adverse. They want a fixed rate. And that's a tough product on a HELOC. It doesn't really exist, but we created it. So we have a fixed rate HELOC product, and that allows the stability of knowing where your rate is, but the flexibility of future draws. So between our products, our price, and our service, I think we're in an extremely great position to continue to grow our market share.
All that stuff sounded real good. And I also want to give you credit for when I asked about what's going to happen in the space, you saying I don't have a crystal ball there. Nobody does. Nobody knows where rates are going to go. If they did, you're right. They'd probably be on a beach in the Caribbean somewhere rather than trying to tell people where rates were going. Let me ask you to play your crystal ball for this, though. What's on the horizon for spring EQ? I know you kind of teased us with some of the strategy meetings you mentioned, but give us a spoiler alert here.
We're consistently looking at how we can serve the broker community and the clients better. And where we've seen, huge growth along with everybody else is in the non-QM space. So one little teaser I'll give you is that non-QM is very attractive to us and has been for the last 6 or 7 months. So don't be surprised to see some non-QM products coming out of Spring EQ very, very soon. The second thing that we've consistently been working on is bringing technology to the marketplace. And some of our competition has done a really nice job of bringing platforms out that reduce the cost to originate for the broker community. And we've got to give the same offering to our people. So we have been working on that project for close to a year at building technology to bring those operational expenses and efforts off the brokers. So those two things, non-QM and really nice advanced technology, is in the near future for Spring EQ.
I wish you the best of luck with that. This is good stuff. It's always a pleasure talking to you, so I appreciate you making the time, and I'm sure we'll have you back on at some point soon. Thank you.
Thanks, Robbie. Appreciate it.
Data released yesterday from the JOLTS report suggests a labor market losing momentum, with job openings in August remaining flat and the vacancy rate holding at a cycle low of 4.3%. Hiring demand continues to soften, leading more workers to stay in their current roles, which in turn is easing upward wage pressure. While layoffs remain low, the declining quit rate raises concerns that job cuts could increase. Meanwhile, consumer confidence dropped to a 5-month low in September amid growing worries about job prospects and the overall economy, marking the second consecutive month where the number of unemployed workers slightly exceeded job openings, a dynamic not seen since early 2021. Today's economic calendar kicked off with mortgage applications decreasing 12.7% from 1 week earlier, according to data from the Mortgage Bankers Association's weekly mortgage application survey for the week ending September 26, 2025. The drop coincided with the highest mortgage rates in 3 weeks. Speaking of drops, we've also received the ADP employment report for September, where we learned that the U.S. economy shed 32,000 jobs last month. On tap later today is final September S&P Global Manufacturing PMI, the ISM equivalent. Both are expected to show continued contraction. Construction spending for August, expected to fall for the 10th consecutive month. Treasury activity, that includes a buyback in 3-year to 5-year coupons. And remarks from Richmond Fed President Barkin. We began day one of shutdown, with agency MBS prices unchanged from Tuesday's close, the 2-year yielding 3.59 and the 10-year yielding 4.15 after closing yesterday at 4.15%, down 8 basis points from where it began September. Let's wrap up with a joke and some housekeeping. An elderly man in Louisiana had owned a large farm for several years. He had a large pond in the back. It was properly shaped for swimming, so he fixed it up nicely with picnic tables, horseshoe courts, and some apple and peach trees. One evening, the old farmer decided to go down the pond. He hadn't been there for a while, and he wanted to look it over. So he grabbed a 5-gallon bucket, bring back some fruit, but as he neared the pond, he heard voices shouting and laughing with glee. As he came closer, he saw it was a bunch of young women skinny dipping in his pond. He made the women aware of his presence, and they all went to the deep end. One of the women shouted to him, "We're not coming out until you leave." The old man frowned. "I didn't come down here to watch you ladies swim naked or make you get out of the pond naked." Holding up the bucket, he said, "I'm here to feed the alligator." Thanks again to Spring EQ for sponsoring the podcast this week. It's one of the nation's leading non-bank home equity lenders, giving partners more ways to serve customers. Known for speed, service, and innovation, Spring EQ makes tapping into home equity easier.